Well, hello everyone. Thank you for joining. It's my morning, but I think it might be the afternoon or even the night for some of you. My name is Knobel. I am a lawyer. I work at TJN, and I'm also part of the FSI, the Financial Secrecy Index team, together with Moran and Oriana, who are also part of the call today. I really hope your expectations weren't too high. I mean, this is more of an exploring and brainstorming session about a corporate tax abuse index that we are hoping and planning to launch. I mean, if everything goes well, by the end of next year. But we are still in the exploratory situation, so we don't have many definitions yet. We have many ideas that we have been discussing, and the idea here is to share those ideas with you and also get feedback from you on what could work and what may not be the case. The first presentation, the first time we started working on this, or at least presenting this, was last year at an eCrypt event in Bogota, in Colombia. That was when we first got some of the feedback. And then some of the things I will show today are just incorporating other ideas and indicators used, for instance, in the index prepared, or at least list or last paper prepared by Oxfam on Race to the Bottom, the 1998 OECD report on harmful tax practices, the EU Commission's work on structures of aggressive tax planning and indicators, and also a paper by Richard Murphy and Andrew Baker on a new framework for analysis of spillover effects. So in a way, I will be presenting some of the ideas that have come up of just looking into indicators that other indexes or other papers have used in the past. Okay, so moving on. So as you can see from this slide, and this is just very basic, I'm sure most of you are very familiar with all of these issues and concepts, but we think of illicit financial flows as individuals and companies transferring and moving money that could be either from a legal origin, such as business income, or from an illegal origin, such as bribes, drugs, slavery, corruption, etc. And they use tax havens either for transfer pricing, for base erosion, to hide assets, either through banking secrecy or free ports, or just to hide their identity behind anonymous companies or trusts. And then everything is related, either market concentration, regulatory avoidance, tax evasion, money laundering, corruption, finance of terrorism, and many other crimes. So in a way, even though any tax haven could be offering any of the measures or provisions that they do, we can think of them in two, just from an analytical perspective, in two different ways. Either tailor-made rules, addressing especially the cases of tax avoidance, and then secrecy, especially through the hiding of assets and identity, which have to do maybe with tax evasion, money laundering, or other types of crimes. So again, even though each country will not really think of this, or each tax haven will not think of this when they are offering whatever provision they offer, one way to think about it, just from an analytical perspective, is to think about the two types of menus that a country or a jurisdiction could be offering. So in the case of secrecy, we have either banking secrecy, anonymous companies, for anti-money laundering, customer due diligence, or no change of information. Whereas maybe for tax or regulatory avoidance, we would have either if a country offers a patent box regime, double tax agreements, a very large network of double tax agreements with very low withholding taxes, secret tax agreements, etc. Now, one interesting thing is that when we think of secrecy, there are three main strategies to create secrecy. Gold, whatever you could own, and either the bank or the real estate purchaser has no information about you. A second strategy is actually hiding your identity behind legal entities or trusts, such as a trust, a company, nominated directors, bearer shares, and many other things, just where the individual hides behind some opaque straight structure. And then the last one is to be doing all of this in several jurisdictions so as to avoid, so as to add one extra layer of complication, an obstacle whenever some authority tries to find out who you are. Now, what we find quite interesting and in a way upsetting is that many tax haven lists, and that is especially many of the national tax haven lists, tend to focus only on exchange of information agreements. And the worst part is only those exchange of information agreements that allow the or that are based on the upon request standard. And just by looking at this slide, you can see that that is just a very minimal part of the whole secrecy strategy. So only by identifying if you have an agreement with 10 or 12 jurisdictions, or if you're planning to have one, that doesn't mean that secrecy is being solved. So in our response to the typical tax haven lists is that we have obviously the Financial Secrecy Index, which looks into many other aspects. So we try to cover all of the aspects and perspectives of secrecy. And the FSI, this is the second webinar of the FSI. I'm sure most of you are also familiar with it. This year, we are actually including for the next FSI that will be published either by the end of this year or maybe early next year, some even new indicators. But I'm sure Moran has already spoken about that in the last FSI webinar. But even though the FSI is very comprehensive, or tries to be very comprehensive about all the secrecy provisions, the truth is that it also has a problem. And what is it? It is that the FSI creates a ranking. And in this ranking, which is obviously focused on secrecy, there are many jurisdictions that we know are really bad tax havens, especially in terms of tax avoidance, that look pretty good on the FSI because they're not as high in the ranking. They're not in the top 3 or the top 10. We have the case of Luxembourg, but then other cases such as Bermuda or Ireland or the Netherlands are pretty low on the FSI, and that could suggest to some people that then they do not represent a problem, that then they are not a tax haven, or that they are completely fine. And here what I'm showing is that precisely, the number that you see on the left, either if it's on number 6, number 24th, or 41st, that's on the FSI ranking. But if you look into the SS, that means the secrecy score, you will see that effectively even Ireland has a secrecy score of 40, or the Netherlands of 48, which is not as bad as, say, Samoa or Panama that have 86 or 72. So that's why, from the perspective of secrecy, some tax havens don't look as bad, and that could be creating a wrong impression that they don't have a problem, or that they aren't a problem globally in terms of easy financial flows, especially with regard to tax avoidance. At the same time, when we look and when we think of tax haven lists that try to identify the avoidance side, or just whatever has to do with the tax part, here's one very basic example of a somehow complex tax avoidance scheme or strategy, which is the double Irish Dutch sandwich. Again, I'm sure most of you are familiar with it again. It involves some classification rules according to the US. It allows a company, say Google in the UK, providing operations or support in one country, say the UK, but then billing them from a different place, which is Ireland, using 2 Irish companies so as to exploit Irish tax residency rules, and then also a Dutch entity to exploit and make use and take advantage of many of the double tax agreements or other types of agreements that the Netherlands have and the EU has, so as to avoid paying withholding taxes. And only then, some of that profit, or maybe all of that profit, or most of it, will be, in a way, booked in Bermuda, where there is no income tax. Now, the interesting, and again, upsetting side of this is that however complicated and sophisticated all of this scheme is, many tax haven lists only focus on Bermuda just because it has no income tax. So even though this is tax avoidance is obviously extremely complex and sophisticated, most lists just focus on one easy side, which is, oh, no income tax, as if that were the only problem with tax avoidance. Now, the solution to that, just like we have the FSI, as a solution to the very narrow-minded of many tax risks. On the secrecy and transparency side, we are now proposing this Corporate Tax Abuse Index, or CTAI, in order to address this narrow-minded when looking at tax avoidance. Now, the question is how we should do this, or what should this Corporate Tax Abuse Index cover, or what should it be like? And here we have two options, at least we think of two options. They might be self-excluding, or we might even find some common understanding or common ground between the two of them, or even maybe join them. But as of now, there are two different options on how to see this. One way, which is actually the one I will be presenting today, is to have a CTAI, so a Corporate Tax Abuse Index, which is equivalent and just based on the FSI. Basically, we would be looking at the jury situation in any jurisdiction and look at indicators that would show that tax avoidance is being enabled in that jurisdiction. Now, a different perspective, and just something which in a way has nothing to do with that, would be to identify only the scale of misaligned profits present in each jurisdiction. And this could be based on country-by-country reports, supposing that at some point the OECD makes some information public, or that the EU manages to have these country-by-country reports public, at least for EU companies, or at least using the BI data on US multinational entities, or even Orbis. And that is something that actually Alex Topham from TJN, together with Peter Jansky, worked on a working paper from 2015, measuring the misalignment about the location of US multinationals' economic activity versus the location of their profits. So these are two different perspectives on how to address the issue of a corporate tax abuse index. Now, why do we have this proposal in the first place? I mean, why the difference? Why not just go for a full FSI-based type of index? Now, the case of the FSI is that there is no estimate on how much money is actually being hidden or laundered or evaded in each jurisdiction. We don't know that. I mean, we wish we could know that. What we do instead, because we do want to add some measure of what happens in practice, is we use the market share of financial services for non-residents, which is the FSI's global scale weight, as a proxy for that. So on actually knowing how much is going on in each jurisdiction, we cannot know that for sure. What we can know is that, and what we have available to us, which is one of our best sources for information, is that we have many Global Forum peer review reports and many FATF mutual evaluations on anti-money laundering that cover more than 100 jurisdictions and even cover these not just for 1 year, but they keep updating. So we have a pretty good analysis and an external assessment of countries' laws and regulations, and even sometimes what happens in practice about the things that the FSI looks into, which has to do with secrecy and transparency, such as banking secrecy or beneficial ownership registration. Now, in the case of the CTAI, so the Corporate Tax Abuse Index, we have the opposite situation. We could have some possible, or it could be possible to estimate the scale of misaligned profits present in each jurisdiction, based again on CBCR, once we have that, or just using what Alex Topham and Peter Jansky did in the past with data on US MNEs, and then Orbis just to get into Japan and some European countries. And then on the bad side, what we don't have is we don't have any kind of peer reviews or mutual evaluations on jurisdictions' harmful tax practices. The only case we have is for the EU countries, and that is thanks to the EU Commission report on harmful tax or aggressive tax planning structures that they published, I think it was last year or 2 years ago. But that is the only case that we have, and we know that it is a very complex and sophisticated issue, so it is not so easy to find the data for that. But let's at least, since maybe more of an FSI-based CTAI will be more robust and would also provide not just what is happening in practice, but trying to understand why that is happening. I mean, what laws or regulations available in each country are the ones enabling that, and also showing to activists, to policymakers, what should be changed. We are thinking, or maybe the option that I will be presenting now, is what would this FSI-based CTAI look like? Basically, what if the CTAI had the same structure as the FSI? What would that look like? So just as we also explained this for the FSI, the idea here would be that the CTAI would clarify the real issues. So maybe we wouldn't be speaking about tax haven, but maybe a CTA jurisdiction, a corporate tax abuse jurisdiction, or even, well, we could even keep the tax haven term. But we wouldn't be looking only at the tax rate or the no tax rate, but we would also be looking into the provisions that enable tax avoidance. And there's something here which says 3 classifications, and we'll get into that later. That's something that the FSI doesn't do. The FSI just, in a way, credits jurisdictions and things that every jurisdiction lies somewhere in the spectrum of between full transparency and full secrecy, so you're somewhere in between. But here the idea is that there could be 3 classifications, in a way 3 spectrums that I will come very shortly into that. And again, we would try to show that not to have inconsistency or have the usual exclusions. One thing that's happening at the EU is that even the EU blacklist will not consider other EU members in their blacklist of tax havens. And we don't want just to be all the time pointing fingers only at the small Plump Islands, but also at many respectable and rich OECD countries too, because in the end, they are many times obviously very much responsible for all these issues. And again, we don't want to have something subject to political pressure, which is usually the case with tax haven lists. And we want to have something like the FSI, which is objective and verifiable. Now, I'm sure that for most of you, the big question is, what about secrecy, or what role does secrecy have here, or what is really the main difference between the FSI and the CTAI? Is there a difference? Does it make sense to have 2 different indexes? Should we just combine them both? So as we say, and even as the FSI name indicates, the FSI focuses a lot on secrecy. It's part of its name. So when you think of the crime or the illegal or illegitimate activity underlying, in the case of secrecy, we have, if we think of tax, we have tax evasion. So when someone has to pay a tax, but they just don't do it, they just don't declare their income, and they do this, or they manage to do this just by hiding whatever they have, either hiding their income or hiding their assets. But of course, the secrecy could be exploited for money laundering, for corruption, for finance of terrorism, or many other things. In the case of the CTAI, as we said, what we're trying to focus is on the tax avoidance. And maybe, if we can also manage to do it as well, some of the financial regulation indulgence, especially when it comes to investment funds. Maybe the best case there is the Cayman Islands. So, I mean, what role does secrecy have here? Or how do we differentiate between the 2 cases? So one way to put it, and this is not as clear-cut, but at least from an analytical perspective, one way to put it would be that in the case of the FSI, we see of secrecy against all authorities. So you think of an individual that just uses banking secrecy, or just hides behind shell companies or some company allowing bearer shares, and he doesn't want any authority whatsoever to find out about his identity. So it's secrecy against all authorities. Whereas in the CTAI, there could be some case of secrecy. I mean, secrecy could still be relevant in terms of tax avoidance. But in this case, it would be at least together with one authority. And the best case here, the best example is the LuxLeaks. So here we had many MNEs coming together and having secret agreements with the Luxembourg tax authorities. So they didn't keep it secret to the authority of Luxembourg. They did keep it secret to everyone else, to all other taxpayers, to the public, to journalists, and also to the authorities of their home countries. But at least with one authority, there is actually some agreement. So this would be one way to put it. But I would be happy to know whether you think this distinction makes sense, whether there is actually a distinction, or whether you think that both concepts and both indexes are too tied together and are too much of the same thing. So I would be happy to hear your views after I'm done with this presentation. So going into the CTA structure, and again here we are just thinking, we're using the same slides that we use for the FSI. The idea here would be, and this is just one idea, to look into the facilities, either laws, regulations, or lack of enforcement, or policies in practice offered by each jurisdiction that enable multinational entities. Here we are reducing the scope. So maybe we wouldn't be looking into local small and medium enterprises or even individuals. We would be focusing on multinational entities or just big corporations to escape or undermine their tax obligations that would be otherwise applicable in any jurisdiction, even in the jurisdiction offering this tax advantage in practice. And how are they doing this or enabling this? Well, it would be either by using their tax law or practices as a prime tool. And then the idea, again, would be to weight this by the jurisdiction's global scale weights. So in the case of the FSI, we use as a proxy the financial services for non-residents. And here we would still have to come up with the effective global scale weights for the CTAI. One idea is outward FDI by GDP. Here we have the example of BVI, that what you see of foreign direct investment coming from the BVI is huge compared to its GDP. And it obviously makes no sense that it's not that BVI residents are investing all that much money abroad, but it's just that the countries are just using BVI as some conduit or as some hub from where to do their FDI. So that could be one example of one idea. So here is some examples, and as I said, it's not that I just came up with all these ideas. Some of them, we thought about them after brainstorming in TJN. Some of them is just looking into other indexes or papers, ideas or indicators or just measures of these of the global scale, which in a way would be, okay, but what happens in practice? Regardless of the laws, regardless of the legal framework or the practices, what is happening in practice in terms of numbers? So one idea would be to incorporate this option 2, which would be to look into the scale of profit misalignment present in each jurisdiction, just again based on the CDCR data or just in the paper by Alex and Peter Jansky. And again, these aren't self-excluding necessarily, these could all be added, this is all open to discussion, would be outward FDI per GDP. And here the data sources could be the FDI stock or flow data by the IMF or UNCTAD, or even the FDI income data by the IMF balance of payments statistics. Other things, and these were used by Oxfam in its last paper about the race to the bottom, where jurisdictions where most US multinationals' excess profits were located. This could be somehow related to the scale of profit misalignment. Jurisdictions with gross intergroup debt assets above 10 billion and more than 20% of GDP. Jurisdictions where most multinationals hold subsidiaries, and these, well, Oxfam explained where they took this information from. And then something that we actually is very easy to, I mean, the source is already there, and actually the FSI looks into this, is the presence and number of Big Four offices. Sometimes when we look at the FSI, we see that even very tiny countries with very few population, with very small population, have maybe 3 or 4 offices of either Pricewaterhouse or Ernst & Young. So clearly, there's a lot of tax accounting and some financial strategy going on there that has not much to do with actual activities in the country. So this has to do with the global scale weight. So just to measure, have some idea of how important in practice a jurisdiction is. Just for those of you who are not that much familiar with the FSI, what we sometimes explain this is with 2 buckets of money. A tiny one with a huge loophole, with huge secrecy provisions, and then a very small bucket with not so big secrecy provisions. So the idea is that one could be saying, if we only look at the EU situation at the legal framework, is, well, clearly those jurisdictions are much worse. And here we think of Samoa, Vanuatu, Panama, which have pretty high secrecy provisions. But what we're trying to say is that there is so little money going there anyway, just to be hidden or evading taxes or just to be laundered there, that even if those countries became fully transparent, we wouldn't even tell the difference. So it would be very hard to tell the difference. Whereas if the big countries, which are the big financial centers, became more transparent, even if they're not as secretive as those countries like Vanuatu, we would tell a difference, and in practice they have much more relevance to solve the problem of illicit financial flows. And here the idea would be the same. Not to only look at countries, say, what if Vanuatu were the one offering all the schemes for tax avoidance, but then no one really goes there. So we want to combine this in some way to know, to have some kind of connection to what is happening in practice, but also to understand why this is happening, and that is why we do have the URI indicators. So now we're going to the indicators. So one thing which is different from the FSI, as I was saying, and this refers to the 3 different types of classifications, is that one way that we think about it, and this is based on the EU paper on the structures of aggressive tax planning, is that they think that they have indicators according to 3 types of jurisdictions. The destination jurisdiction, that they call as the active aggressive tax planning, or ATP, and here would be a case where foreign income is exempt, or where effective tax rates is very low compared to a global average, and it is the place which is the location for holding passive investments and where paper profits can be booked. One case would be Bermuda here, where in the double Irish tax sandwich, where the actual profits are booked because they have no income tax. And there could be 2 different ways that maybe we could classify these. Either when a jurisdiction like this, say Bermuda, favors non-resident MNEs compared to resident MNEs. But another way, or even an additional one, would be to say whether MNEs in general are favored over SMEs or individuals. So whether anyone who can just have multinational entities and operates in different jurisdictions gets the benefits, gets the tax benefits, which is not available to an SME or just an individual from that jurisdiction. Now, a different classification would be conduits or channel jurisdictions, and this is what the EU paper calls passive ATP, or aggressive tax planning. And these are the ones that allow the base erosion and profit shifting to be moved towards a destination jurisdiction where they will not be taxed. Maybe one example of this would be the Netherlands, and using its large tax treaty basis for that. But then another thing that we think, or at least I am convinced, and maybe there is no consensus on the GN side here, is to also classify the source country, say a developing country. So I call this inefficient source country. In the case of the EU paper, it's the lack of anti-abuse, ATP, aggressive tax planning. And here's when we think of a country that does not effectively prevent tax avoidance or base erosion or profit shifting of the source income, of the income generated in that country. And they could be doing this either deliberately through tax incentives or negligently, because MNEs are in practice able to exploit both conduit and destination jurisdictions because there are no CFC rules, so no controlled foreign corporation rules, or the country itself has no anti-treaty abuse provisions. So the idea here would be to classify all jurisdictions that will be covered by this index according to each of the 3 classifications. So one country could be really bad as a destination jurisdiction, but then really good as a source country because, I mean, even though they help all other MNEs to go to the jurisdiction to avoid taxes, they are pretty good at preventing their own MNEs and their own individuals from avoiding taxes. Or there could be the other case if we think of some developing country in Latin America, I don't know, Bolivia or Argentina, which are not especially good or are not especially seen or known just for enabling tax avoidance of other MNEs, so they're not usually thought of as a tax haven. But still, they could be doing way more to prevent tax avoidance from affecting them, and they're not doing enough. So we think that we should also be pointing fingers at those countries and showing to those countries and activists from those countries what they should be doing so as to prevent, as long as it is within their hands, to prevent tax avoidance. At the very least, to have anti-abuse provisions, either in their domestic law or in their tax treaties. So this would be the idea. So now we're going to move on to the very specific indicators. Many of them are very complex. As I said, some of them are some that we thought just based on our FSI experience, and some of them I just tried to look into all these papers and indexes that I mentioned before, the EU aggressive tax planning indicators, the 1998 OECD report on harmful tax practices, the Oxfam index that was published very recently, this paper by Richard Merton and Baker on how to rethink spillover effects analysis, and also some feedback I got at the ICRIC meeting in Bogota last year. So all these indicators are either would be relevant for one, two, or maybe the three of them. So that's why we have the three columns indicating for which type of classification each indicator is relevant, and many times they are relevant for the three of them. But the big question here, and here we have some ideas, but it would be great to get your feedback, is whether we have enough sources for this. Because at the end of the day, this will be the big obstacle. We could think of what the best indicators are, what the best way to measure tax avoidance or enabling of tax avoidance is. But if we don't have any source that we can use, if we don't have any information in the end, in a way it could be rather useless. Or if not useless, we couldn't really use it in an index to actually measure and classify and assess jurisdictions. So as I go with the naming and just saying 2 words of each indicator, if then you have any idea of which a source for that indicator could be, please let us know, either after doing the questions or in the future just by email or just bilaterally. So yeah, so I will just go over now to those indicators. So these are the indicators, and again, the first column will always be the destination or the active. Think of Bermuda, where there is no income tax, or where profits are booked. The second column has to do with the conduit or jurisdictions or channel jurisdictions or the passive aggressive tax planning, and these are the ones enabling this transferring from the source country to the destination jurisdiction. Maybe a jurisdiction is both. I mean, maybe the Netherlands offers 2 things, and maybe Luxembourg offers both, and maybe Luxembourg would be on the top according to the 2 classifications. But the idea here is just from an analytical perspective to differentiate between these 2 cases. At least that's what the EU paper did, and I thought it was useful. So again, I would be more than happy to get your feedback on that. So the first one is promotion as tax haven. And here the question is whether a jurisdiction offers itself or is perceived to be a place used by non-residents to escape tax in their country of residence. So one idea, I mean, I will not have examples or much information for all of them, but at least I will try to give for some of these. And we see this a lot when we do the research for the FSI. There are some websites such as Low Tax, Offshore Investment, Offshore Simple, that just name and identify the best cases or the most well-known jurisdictions where you can do this. And you can also have many jurisdictions that have actually some marketing department, some international offshore center people just focusing on promoting the jurisdiction. They don't really say it's a tax haven, but because of the things that they say, either come to this jurisdiction so as not to pay taxes, come to this jurisdiction so as to avoid automatic information exchange, then we would be clearly saying, okay, this is a case where a jurisdiction is offering itself or where it is being promoted. And many times, I mean, you could think, well, maybe every jurisdiction does that. But actually, when you try and Google that, many jurisdictions, I mean, if you say Bolivia tax avoidance or Bolivian secrecy, you don't really get many ads offering that. Whereas when you say Dubai secrecy or Dubai offshore or Cayman offshore, then you obviously see tons of sites. So that could be one indicator. But again, we would have to be very, very clear on what are we actually measuring or how we really measure that, and that might not be as easy. Another one is whether a jurisdiction attracts financial and other services, but not active investment. Basically here it's where jurisdiction attracts not really a factory and actually employing tons of workers where there will be tons of operations there, but they only offer or only attract banking services or lawyers or accountants who will be corporate service providers, but that's really the only thing that they are offering. One indicator that was measured was present in some other index was that attracts activities for which there is little or no demand or supply in the domestic market. And here again, we can think about, say, Cayman Islands and investment funds. I mean, Cayman Islands is one of the main hosts and hubs for investment funds and mutual funds. But obviously, there is a very tiny population in Cayman Islands. So obviously, those funds are not there just to target and to cater at Cayman residents, but are just a hub actually offering to people that are residents abroad. Another one, which maybe this is just a proxy, is availability of international entities. An example of these are international business companies or international trusts. And we see this a lot in the Global Forum peer reviews, and we describe this in the FSI, because many jurisdictions offer entities that you can just incorporate the entity, but you are forbidden from holding assets in that jurisdiction, say BVI or St. Kitts, or even to contract to engage in transactions with any resident from that same jurisdiction. So any person would say, why do you even allow someone to incorporate a type of company that is not allowed to operate in your country? Well, obviously, because you're just, I mean, that could be one of the best examples of a tax haven in a way, or one of these jurisdictions just trying to help someone else avoid or do some shenanigans affecting other countries. So in a way, you are promoting this, you are getting the benefit out of promoting this, just either because you get a fee for this, because you give money to your lawyers or to some person that will be the director of that, but you don't share the burden, you don't share the cost, because you are preventing that type of entity from affecting your own jurisdiction, your own economy, or your own residents. Now moving on to exchange of information and availability of information, we think that this is relevant for three types of classifications. And this is something that we also look in the FSI, is whether all legal structures, companies, partnerships, trusts, foundations must keep accounting records, including underlying documentation, for at least 5 years. So that would be the very basic standards, just to make sure that whenever someone is saying or trying to justify anything, you can actually go to the accounts, you can actually go and find the underlying documentation that supports that. And then it is also relevant if if all of them also have to submit these accounts to a public authority. Ideally, if they were public, but at least to have some authority having that, so as to make sure that they will be doing this, and also to make sure that they will not change it by the time some authority asks for this information. Another thing would be the number of upon request relationships. Of course, they would have to be compliant and enforced, and this could be the double tax agreements, CTAI'S, TAI'S, which are tax information exchange agreements, or whether they are party to the multilateral tax convention. And a multiplying factor, something that we could say, okay, this makes it better, is whether they have relationships with low income or lower middle income countries. That is to say, to avoid tax havens such as Guernsey only having EOI agreements with Jersey, Isle of Man, and I don't know, BVI, when we want those countries to also share information with developing countries. Now, you might wonder, why do we still mention the upon request standard when now we have the CRS and automatic information exchange? Well, for those of you who maybe not be aware, AIE is only about financial account information. So you cannot automatically obtain information about accounting balance sheets or transfer pricing documentation from other countries. You would still need to do that using the upon request standard. So the upon request standard is still very much relevant, even for countries implementing automatic information exchange. Another point would be whether countries signed the MCAA, the Multilateral Competent Authority Agreement for CBCR. That is something that is needed to exchange CBCR, and also means that you're actually requesting the CBCR from your home MNEs. And then the number of activated relationships for CBCR, because again here what we care is to see how many countries you're actually showing or sharing this CBCR. And then something that we think will happen in the future. As of now, this doesn't exist. So you might have heard that based on BEPS, I mean, CBCR and the MCA for CBCR is actually based on BEPS, the Base Erosion Profit Shifting process by the OECD, and that is specific for Action 13. And then another action point that has to do with advanced price agreements, they will also be shared automatically. So I think, I don't know if I heard this or if I just imagined it myself, that they will also be using the MCAA and just be using the same scheme for automatic information exchange. So just like the CRS has an MCAA, and now the CBCR as an MCAA, I think it is very likely that the advanced price agreements will also have an MCAA and activated AIE relationships. And just another point is whether there is information on taxpayers benefiting from any preferential tax regime, so as to know and to measure that. That would make it relevant. Now, going on to BEPS, here we only have 2 points. I think in the future it is likely that we will include more indicators. And again, if you have any suggestions, we are more than welcome. So one of them is whether a country is party to the inclusive framework. This is like the global forum for transparency. The inclusive framework is, in a way, the global forum for BEPS. So they are the same thing. And by being part of the inclusive framework, you are committing to the minimum standard, which, among other, includes the CBCR provisions. And a new thing, which is the multilateral instrument, which is now available for signature, I believe. Here, what we would be looking into, it's not just whether a country signed the multilateral instrument, but also whether at least they are accepting the principal purpose test of Article 7, and basically meaning whether they have these anti-abuse provisions that would be applicable to all of their treaties. And then something else that would be very much related to the CBCR is whether countries require local filing of CBCR by their subsidiaries and by their MNEs. And that means whether they don't really care about what the OECD is saying, but they actually make sure that they will get the CBCR one way or another. That is something that we have written a paper on that, and even written a blog just showing how complicated the OECD scheme is, and even the legislation, the model legislation imposed by the OECD, and how and why we are suggesting a different legislation. And we are very happy now that Vietnam now has followed our advice. I mean, as it was presented by other activists. And now they are also making sure that they will get the CBCR one way or another, even if they cannot get it through automatic information exchange. So we will be asking all source countries to do the same. Now, moving on to the tax rates, the question would be whether a country has no corporate income tax rate or below the global average. Looking also at the effective corporate income tax rate, maybe compared to the statutory tax rate. Maybe this could be said because, again, some countries look pretty well because they say, hey, we have a pretty high statutory or nominal tax rate. It could be 30%, 35%, or whatever. But what we really care is about the effective one. So those countries could be looking well in the eyes of other ones, where in practice they are pretty bad. Whereas maybe other ones, they have like a very low income tax rate, so they are more transparent about how much they are really enabling others to avoid taxes. So that could be one idea on how to measure that. Then thinking about double tax agreements, what we could be looking into here, which has nothing to do with the exchange of information provision, which is what we looked about. Here would be only the withholding taxes, maybe just averaging the withholding taxes of all of a jurisdiction's network of CTAI'S. So for the first type of classification would be the inbound withholding taxes for dividends, royalties, and interest. For the second one, which is this country which requires dividends and royalties to come to the jurisdiction and then to leave the jurisdiction. So we would be covering inbound and outbound. And then for the third one, we would only be looking at outbound. But again, this is just one proposal. Moving on to the tax phase, we would look whether there are hybrid entities. And that would affect the tax base because according to some jurisdiction, maybe an entity is transparent, so it will not be taxed at the entity level, and then according to the other jurisdiction, if it's not transparent, so it would be subject to tax. Or the same thing would happen with transactions, either when some transaction is considered equity in one case, or loan, or interest, or debt, sorry, in a different case, or whether something is assumed as an expense or not in the other case. And then we would be having two different types of ring fences. So one would be of ring fences which isolate one type of entity from domestic economy, and that would be an example of any of these entities which are not which cannot transact with domestic either hold assets or do anything. And another one would be some ring fence, which is available only to non-residents, so maybe to non-resident individuals, although in a way the CTAI would not cover individuals, but maybe just for non-resident entities, either if they are non-doms or just a lump sum payment instead of actually having to pay taxes on whatever foreign income they have. Or if a country offers ring fences which are available to local MNEs, but not to SMEs or other types, and this would be an example of federal foreign income. Another point is the artificial definition of tax base, and here now we're getting into the more complex cases, but basically, and this is part of the I think the EU Commission paper of indicators where they think of rules that allow costs to be deducted even though the corresponding income is not taxable, or rules allowing deductions for deemed expenses that are not actually incurred, rules that permit overly generous reserve charges or that otherwise restrict the tax base for a particular operation. So this is extremely specific, extremely complicated and sophisticated. So I don't know, without some paper like the EU, I don't know how likely it is to measure this or to know this, whether this is available in any jurisdiction. Then the case of whether excess profit rulings are possible. Then moving on, whether there are too generous tax exemption of dividends received. And then again, we would have to define what this too generous means, what is the threshold here, or whether there is no withholding taxes on dividends, royalties, or interests which are paid. That means that they don't even exist, these withholding taxes, under domestic law. Then we look into what the treaties say, what the double tax agreements say. But this would be looking only at the domestic law. Or if there is no withholding taxes on dividend equivalents. An example that they give is the buyback of shares. So maybe it's only for something that is called nominally as a dividend, but whatever is equivalent of a dividend, but it's not called a dividend, then that wouldn't suffer any withholding tax. Again, then we have tax deduction for dividends which are paid. Then we have, and again, that would be for destination jurisdictions. Then for the third column, which is the inefficient source country, would have income from certain hybrid instruments are not taxable. No income from interest-free loans, tax deductions for intergroup interest and royalty costs. We have tax deduction allowed for due interest costs on interest-free debt. And again, this is getting super specific. It's very complex to understand. It is clearer, and really to understand these very specifics, you would need to look into the EU paper, because they explain first, although it is very hard to understand even with that explanation, how some of the very typical tax avoidance structures work. And then these are the indicators that would measure those specific tax aggressive or aggressive tax filing structures. So you would have to understand these. The question would be whether those, which is supposed to be the case, that those aggressive tax planning structures are available in many countries, and so maybe this indicator would really cover all those situations. So just that indicator by itself would be relevant, or maybe that indicator would only be relevant for that specific tax aggressive or tax planning structure. So again, we're not saying that all of these indicators should be here. What I tried to make was, I don't want to miss anything, even if I don't fully understand, even if I don't fully know how relevant this is globally. I wanted to include everything that seemed relevant for an example of how to enable tax avoidance, and that's why it's here, but doesn't mean that it has to be here, or that it is only relevant for one classification. So then we have notional interest deduction for share capital. So even this means that a deduction is taken even if no loan was actually taken. The patent box regime, I think that is more well known for many people. If we have no taxation of capital gains upon transfer of IP, or if research and development tax incentive is obtainable also for costs that are reimbursed, so why give the tax incentive in the first place? Group taxation with acquisition holding company allowed. Tax qualification of foreign partnership does not follow that of the foreign state, so this would be maybe just a case of a hybrid. or locally incorporated company not tax resident if management or control is in another state, and that is the case of Ireland. That is why the double Irish works. Then, in the case of anti-abuse, this is especially relevant for source countries, just to make sure that they are doing what is at their own hands to prevent tax avoidance. And the case would be lack of CFC, lack of control for incorporation rules, lack of foreign investment fund, FIF, or equivalent rules to complement the CFC rules, no exemption of foreign income, does not restrict deduction for payments. I see that I don't have that much time, so I will try to move faster. There's not really that much left. Does not impose withholding taxes on payments to tax havens. The tax treaties, so that's why before we looked into the domestic law, and now we look into the tax treaties of a jurisdiction. They don't have anti-abuse provisions. They don't have, I think, capitalization rules. What's in red is what it was even very complicated even for me to understand. That's why I put it here, because I wasn't sure if I got it right or if it is really as relevant or not. Does not prevent the use of derivatives to create synthetic loans. There is no taxation of benefit from interest-free debt, no interest limitation rules, no beneficial ownership test for reduction of withholding taxes. I mean, I understand some of them, so if there's any question on how this works, I can either explain it to you or even show you the part of the EU paper where that is available. No rule to counter mismatch in tax qualifications, no rule to counter mismatch in domestic company. Well, there's some mismatches cases. No general or specific anti-avoidance rules. And this is the last slide on indicators and almost the end of the presentation. So the idea would be to also look at the tax administration. So whether they have favorable administrative rulings such as APAs or some negotiable tax base or some other rates, or whether the situation, I mean, the nominal case, the statutory tax laws are fine, but there is a lack of enforcement in practice, either because they didn't have any audits or they're just very lax. This one would also be in red because it's also, I think, a bit complicated maybe to assess, which would be the misapplication of transfer pricing. And they give some examples of what that would mean, or if they don't allow tax claims by other countries, or if they have unilateral rulings on interest spread or royalty spread. And then this is something that came as feedback in Colombia, where there is direct access by large taxpayers to discuss issues just in the phone line, which for some people it could be a good thing because it makes it able to clarify the issues. But then for others, it could actually mean that they are just discussing the things or getting some advantage that no one else is aware of. Then if the tax administration has a transfer pricing unit, so some people specialize in the issue since it's so complex, at least to address it better. If there is a revolving door between the tax administration and the private sector, and then two very brief indicators for investment funds. This just shows that we would like to cover this in some way, or although we're not entirely sure how, is whether they have effective look-through or trace on the trace system, if they are part of the trace scheme by the OECD, or if there is this regulatory indulgence, which is available in the Cayman Islands, and that is the reason why so many funds are actually hosted there. So now the questions a bit for you or for all of us, before I actually open the floor for your questions and your feedback, is I think what would be ideal, based on the option 1, which is to have an FSI-based CTAI, so basically a corporate tax abuse index that will be based and have the same structure of the FSI, would be which are the indispensable CTA, corporate tax abuse indicators, for the CTAI to be valid or relevant. I mean, if we only looked at no income tax rate, that would be quite easy to get, but we know that it's not relevant or that it's not valid enough. But then for those which are indispensable or which are the minimum that we need, which are the sources to assess those CTA indicators? And that will be the crucial point, because if we cannot assess that, then there is not really much that we can tell, or maybe the CTAI wouldn't really have much of a point. So otherwise, say that we don't have the sources, then we could work on option 2 only, that is only to list the misaligned profits present in each jurisdiction. Or another idea would be to also do that, because we only have the de facto situation, we cannot assess indicators, we cannot assess the EU situation, but at least we list these unassessed CTA indicators that should be assessed, for example, once peer reviews are available. I heard by Sol that, I don't know if there is an idea or it's just something that will happen in the future, that because of BEPS, the inclusive framework will also have peer reviews, like the Global Forum does for transparency, and they will have peer reviews on harmful tax practices. Maybe then that would be the solution. And until then, we just publish this list and we say, well, this is what we should look into, or maybe what any local expert could look into. But again, we're also open to other ideas, and we would also like to hear your views about whether there is really a difference between the FSI and this new corporate tax abuse index, and whether this difference is clear, or whether we should be either conceptually or from the development side make it clearer. So from me, that is it. Thank you very much for your time and your attention. And now I think Oriana will try to organize the questions and comments that you may have. So thank you.
Thank you, Andres. Hi, everyone. This is Oriana Secada from TGM. I will assist Andres in managing your questions. Please note that the entire webinar is recorded and will be published online. As explained by Moran, if you have any questions or remark, raise your hand so we unmute you, or just write your input in the chat. Additionally, before you ask a question, we kindly ask you to mention your name and the organization you are representing. I see that Chen already raised his hand, so I will unmute you. Hi, Chen, do you hear us?
Hello, oh, sorry, I don't have a question yet.
Okay.
Hello, hello?
Yes, Chen, we hear you. Could you please ask your question?
So sorry, I don't have a question yet.
Okay, thank you. Dennis? Hi, Dennis.
Yeah, this is very interesting. I think it's helpful in that we are in a situation where the OECD is applying political measures rather than objective measures, and it's unfair to some smaller island tax havens, and they deliberately ignore, places like Luxembourg and Delaware. So a more objective measure is helpful, but also it's helpful to point out the specific policy areas that each country needs to address. So I'm thinking from an advocacy point of view, it would be helpful to know what are the things that Canada is not doing properly, and then we can pressure the Canadian government to address those problems. And even if, overall Canada ends up being somewhat in the middle, there are still serious problems, and this measure could help us identify where are the problems in Canada that we should be going after the government on in Canada. So having a comprehensive approach is helpful, but at the same time, we found it difficult to do media work around the current FSI because it itself is pretty complicated and beyond the ability of many journalists to understand. And it's also beyond the ability of some of the cabinet ministers and politicians to understand. So even though I think you need to do a comprehensive analysis, there's also a need to really summarize and simplify the main conclusions in a way that is more useful for doing media work and for political lobbying. So although I support, a more detailed, comprehensive approach looking at all the things, don't forget about the need to make some conclusions, summarize, and, put it out there in a way that we can use in terms of doing media work or political lobbying work.
Thanks, Dennis. I mean, definitely that is something that we really care about the FSI, and we really try our best to at least do the media press releases so you can have the narrative reports, which are simpler than just the full database. But if you have any feedback or any idea on how to do that better, I mean, we actually will try to be way better this year with more infographics and better ways to understand and look at the data of the FSI. But the main point of the FSI is that it takes us a lot of time and it is very complex, but whenever we get criticism and someone says, oh, that's not true, or I am not a tax haven, we have the FSI, we have the very detail and the sources and everything to say, yes, what we are saying is actually true, or this is what the Global Forum said, this is what the FATF said. So there's a reason why we're saying what we're saying. It's not just that we feel that you're a tax haven. We have the evidence of why we say that. And that is what we would maybe in a way be trying to have with the CTAI as well. So I think, I mean, I also agree, and that's why this presentation is here, and why we're trying to get your feedback, just to know which are the indicators and which are the measures that, as you say, each country should do so as to prevent either being an inefficient source country or also to prevent being a destination or a conduit jurisdiction. So I would also like to get your feedback on which of all those measures or indicators you think are relevant or which aren't so relevant. But at the same time, the question is, what if we can't find the sources? I mean, what if we find that the most relevant indicator is whether, I don't know, tax deductions are possible or are not possible in our countries? And that is very hard to tell. So would it seem like sense to have a CTAI? Should we just not do it? I mean, if you have any feedback or any idea on that, we would also welcome your proposals or suggestions.
Are there any other questions or interventions? So far, there is no question. Andres, would you like to say something further, or should we end here?
No, this might have been a lot of information for all of you. I mean, I hope you understand that we are really in the exploratory situation now and just brainstorming and trying to, I mean, from the original and the first brainstorming, just trying to narrow this down to identify the specific indicators, or even just to decide or to think about whether it is possible to do this. I mean, once again, as I said, once we define what are the indispensable or minimum indicators, just to try to look for the sources for those. So if you have any comments that you don't need to do it now. I mean, it was a lot of information. I also have this in a Word document in case it's easier for you to read. So if any of you is interested in that, I can also share that. So if you have any proposal or any comment, either of a good source or a new indicator that we haven't thought about, or something that you think that for some reason is not relevant or not so relevant, we will be very, very happy if you send that. And also, again, any other feedback on how eventually we should present this or how to explain the difference between the CTAI and the FSI, anything really would be welcome. And so if you need more time to think about that, you can definitely, I mean, you have my email here. I think you have all of our emails. But again, thanks a lot for your time. And yeah, we will be looking forward to your feedback and your comments.
Thank you very much again for your attendance. And as Andres mentioned, should you have any further questions or suggestions, do not hesitate to contact us. Again, apologize for any inconvenience caused by the time confusion from the beginning. And that's it. We all wish you a great day. Thank you.